So saving for retirement and gaining financial freedom can take a long time. What if we could show you how to cut that time in half or even more?
Are you a working professional but struggling to balance the workload of your career, family, obligations, and preparing for your financial future? If so, this podcast is for you. You've spent years learning your craft, and now it's time to focus on your financial future. This podcast will teach you what you need to retire wealthy and happy. Let's dive in.
So welcome back to another episode of Retire Wealthy and Happy. Today we want to go over several types of investments and discuss the difference between active and passive investments. We also want to talk about estimated rates of return between them. This is a continuation of the foundational information about getting out of the rat race and obtaining financial freedom. We encourage you to listen to these over and over again and share them with other people that you think might benefit from here. So we're going to start, Ben. I'm going to have you take a minute, if you would, and really describe the difference between active and passive investments, and maybe describe some of the different types and expected rates of return for each.
Absolutely. So let's keep it really simple to start. An active investment is something that you have to participate in on a regular basis in order to produce the return that you're hoping from that investment. A passive investment is something that you don't have to participate in on a regular basis, and it just works on your behalf in the background, and it still produces the return without you doing much effort. So let's jump in and look at several different types of investments and whether those are active or passive investments. So first, we're going to start talking about stocks. This could be in the stock market. There's many different kinds of stocks and different ways you can buy into the stock market. And we're going to separate them into growth stocks and income stocks. So a growth stock is something that you buy in, maybe a younger company that is doing really well or has the potential to do really well. And you're hoping that you're going to buy the stock at a lower price and eventually sell the stock at a higher price so that you can get the return that you're expecting. Now, a growth stock could be either an active or a passive investment. If you wanted a growth stock to be an active investment, you as an investor would be selecting the stock on your own. You'd be watching it on a regular basis. If it goes up, maybe you choose to sell it, or if it goes down, maybe you choose to buy more of that stock. Now, if you wanted to use growth stock as a passive investing strategy, you might look at doing something like a mutual fund or an ETF so that somebody else could be managing that on your behalf. But even if you're in that type of an investment, you still need to be monitoring it. So it's sort of passive, but sort of active as well. Now, there's also income stocks. And actually, before I jump into that, you would be using a growth stock to help grow your wealth faster because you have the expectation that the return will be higher than maybe an income stock. So with a growth stock, there's a higher level of risk. And with a higher level of risk, you expect or hope that you'll get a higher rate of return. Now, with an income stock, you might have a company that is not old, but is very established and is producing a really great amount of revenue on an annual basis. And because of that, they're able to pay out distributions or dividends on a regular basis. And you would use an income stock if you needed more cash flow coming into you on a regular basis. But with an income stock, you're going to be getting most likely a lower rate of return than a growth stock because in theory, there's less risk involved. And with less risk, there's generally less rate of return. So that's a quick overview of stocks. We're going to jump now into bonds. Bonds are a great vehicle to get passive income because you're basically purchasing something that has an interest rate tied to it, which gives you payments on a regular basis. So this would be a great option if you were looking for passive income because you could buy a bond and it would pay you out on a regular basis a certain amount of money. So this could help if you need that monthly or quarterly cash flow. A bond is a great investment for that. Bonds generally have a lower rate of return because they are less risky. And a little bit later in the episode, we're going to talk about different types of bonds and the returns you can expect with those. But they are a great vehicle to provide regular income. So if you need that, that's a great option. We're going to talk about real estate as an investing vehicle. Now, if you don't know this, there's many, many different ways you can invest in real estate. And for this quick conversation, we're going to be talking about two options, and that is flipping homes or rental real estate. Now, when it comes to flipping properties, you could be flipping single family homes, you could be flipping commercial spaces. There's many ways you can do that. The point is with flipping property, for the most part, that's a very active investing strategy. There's things that have to be done almost every day with a property flip in order to achieve the return that you're trying for, because the faster you can do the flip, the less time your money is at play, the greater return you have to potentially make with that investment. Now, you could have flipping homes be a passive investment if you were to partner with somebody else. So maybe I partner with Roger to flip homes. He does most of the work, but I provide a lot of the capital. So in that scenario, I could be a passive investor in flipping homes. But for the most part, that strategy is an active strategy. So keep that in mind. You could be active or passive when you're flipping homes. Now, we're going to talk a little bit about rental real estate. And if you're not aware of this, the three people on this podcast, Roger, Earl, and myself, we run an investment real estate company, and we focus on multifamily or apartment buildings. So we have a lot of experience in the rental real estate industry. And one of the common misconceptions, and we're going to talk about this quite a bit today, is rental real estate. A lot of people think it's a passive investment. You just buy a property, you have a tenant in there, they pay you every month, you make money. Seems pretty simple. The sad truth is that rental real estate is very active. There's a lot that has to be done on a regular basis, and there's a lot of cost that plays into it that can really affect your rate of return. Now, one of the things I try to talk to people about when we're talking about rental real estate is that it really needs to be treated as a business. And you could say the same thing for flipping homes. It really needs to be treated as a business because there's income, expenses, there's operation pieces, there's marketing, there's a lot of moving parts that have to be done well in order to get the rate of return that you're expecting. So if we're talking kind of a comparison here, if you're buying stocks, you're not in control of how that investment performs. You're basically saying, I think it's going to go up, so I'm going to buy it, or it's gone up, so I'm going to sell it. That's the control you have. With real estate, you have an opportunity to have a lot more control, which is good and bad. Because if you're good at it, the control can help you produce a much higher rate of return. But if you're not good at it, your return could be really low or it could be negative. There's a good chance you could buy real estate and lose money if you don't know what you're doing. And for the most part, if we're buying investments, we want to make money, not lose money. So with rental real estate, if you want to be an active investor, you could go out and you could buy a property that's a rental. That could be a single family home. It could be a duplex. It could be an office building. Like there's a lot of different ways you can invest in rental real estate. And if you want to be doing the day-to-day management, you could be an active real estate investor. Now, there's another opportunity where you could be a passive real estate investor, which means you partner with somebody in some fashion where you invest your capital in a project that somebody else is operating that has the expertise, and they're able to do that and produce a higher rate of return. We're going to come back to this as well, but as far as risk and return, real estate has, in theory, a higher risk level, which means you could and should be expecting a higher rate of return from that type of investment. Now, the last category we're going to talk about for the moment is small businesses. If you don't know this, when you invest in a stock, you're really just investing in a business. Most of those are much larger, more established companies that have gone public, and that's how you're able to invest in that stock of the company. You also have, or you might have the opportunity to invest in a small business, which really just means you're buying a stock in the small company. And one of the advantages to buying stock in a smaller company is that you can get in at the ground level. which means you're buying a stock or a share in that company when they're just getting started. And that can be really beneficial because if you put in a small investment into a small company and then they do really well and their profits go up exponentially, when you cash out, the return can be really large. But it's also really high risk because that company could fail and you could lose all your money. So there's, again, the risk reward balance that you have to be dealing with as an investor. And with a small business, you could be either an active or a passive investor, kind of similar to the real estate option, because if you, and this goes back to what we talked about in the last episode with the cash flow quadrant, this is the B category, the business owner. You could be a business owner yourself, such as Earl, Roger, and I have started a business together. We're actively involved in that business. But you could also be a passive investor in a small business where you put some of your capital into somebody else's business and they do the work, but your money is at risk. So that is how you can be a passive investor in a small business. Now, we've talked about a few categories here. I want to ask Earl and Roger if you have any additional comments you want to add to these general categories before we start talking about rates of return.
So Ben, it looks like with every one of these, including real estate, you can take an active approach or you can take a passive approach. And generally speaking, which one is going to give me a higher rate of return, active or passive?
Great question. So active investments should give you a much higher rate of return. And I think we talked about this last time, but if we didn't, the reason for that is because you're putting what you could call sweat equity into the investment. So you're putting your time in, and your time should have a value, which helps you get a higher rate of return on your investment. Does that make sense, Earl?
Absolutely. So the other thing that I'm curious about, is there a time, an age difference on what types of investments we should generally focus on? In other words, when I'm just out of college, is there something I should be more likely focus on versus closer to retirement?
That's a great question. Before I answer that, we should say that all investing is a personal decision because we all start investing at a different age in life. In a perfect world, we would all start investing probably at the age of 16 and we would retire early. It doesn't always happen like that, though. But I think what Earl's getting at is when we are younger and we have more time, it's more likely that we should be investing in some type of a growth investment, which offers a higher risk, but a higher rate of return. And we do that so that we can grow our wealth faster at a younger period in our life, so that when we get to a later phase in life, we have a larger net worth or nest egg that we can use to get more stable investments. So let's say we were in our 20s, we could be investing in really risky things that might offer a 20 to 40% annual return, which would, assuming they go well, we could grow our wealth really quickly. And then maybe when we get into a later stage of life, 60s, 70s, we could be investing in things that offer maybe like a much more conservative 5 to 10% annually, which doesn't sound as good, but because it's less risky, we would have a more stable feeling in our investment strategy, which is something you might want at a later stage in life. Does that answer the question there, Earl?
Hey, thanks a lot, Ben. I appreciate it. Roger, I'm going to give you just a second, and can you take it and just explain to us why it is that we focus so much on passive investments in terms of gaining financial freedom?
That's a great question. The reason why we want to be in passive investments is because something that Warren Buffett focuses on is if you can't make money in your sleep, you'll never be wealthy. When we look at small businesses, there is a high risk, high reward. You cannot invest in a high risk thing in your later retirement because as you approach retirement, you're going to have no chance to recover. So if your timeline is less than 10 years, you've got to avoid all the risky things and get into the more stable things like bonds and very high income, high net worth stocks. The reason why we invest in apartments is because they're like a small business, but they're very cut and dry. If you raise the rents, the NOI goes up, the value goes up. You don't have to worry if that is a good system because everybody knows that we need a place to live. Everybody needs a shelter. Everybody needs a house. There's no getting away from that. If you invest in crumble cookies, maybe it goes up exponentially. But if you invest in bad business that doesn't have the success like crumble, your whole entire investment could be off in the wind. So we like apartments because when you invest in them, they're a small business, but it also has such a strict formula that you really can't go wrong.
Perfect. And I would guess that that as you're starting, you might want to focus more on growth, because the truth is it takes cash to invest in passive investments, right? You have to have some money to put in if you're going to be completely passive. And so a lot of people focus on some sort of active return to get started with. Is that safe?
Absolutely. If you're in the early years, you might even think that cryptocurrency is a good thing because you have such an exponential growth. When you're in a later years, you have family and time obligations, and you don't want to be out there installing tile and LVP and everything else that somebody could really make a lot of money by doing everything. But if you have the operator that can run that for you, you can make money off of their sweat equity and further your wealth and grow money.
Hey, Earl, we talked about this in one of the previous episodes, but in case somebody missed one of those episodes, can you just do a quick overview of how much money somebody might need invested to have $5,000 a month in passive income? Because we're talking about growth and getting to a point where we have enough net worth to live off of that passive income. Can you just do some quick math for us so we can understand that?
Sure. Yeah. The rule of thumb is if I need $1,000 a month of passive income, so for every 1,000 that you need about $150,000 of cash that you can invest in some sort of an investment that makes 8% rate of return. If you could find a bond today that paid 8%, that would work. That would it's very difficult to find bonds that are making that kind of rate of return today, but passive real estate investments frequently are getting 7 to 8% and sometimes a little higher. But for every $1,000 of passive income, you need $150,000. So $500,000 or $5,000 a month, like you talked about, you need about $750,000. And so again, you've got to figure out how to get that money started first, right? You've got to go before you can just throw $750,000 and plan on having $5,000 a month to live on. You've got to go acquire that $750,000 somehow, and you do that typically with more active investments. Thanks, Ben. So let's take a second. We want to talk a little bit about risk-adjusted returns, or at least not necessarily risk-adjusted, but just take a second. You've listed some investments and talk about expected rates of return, typical national averages, so to speak, for some various types of rates of return.
Yeah, so I did some research before this episode today, and I've got some average returns for the investments we were talking about previously. And before we jump into this, I want to say, don't focus on the numbers that I'm going to use here, because these are constantly changing because the market's always changing. What I want to point out is that with these different types of investments, generally speaking, they offer a different rate of return because they have a different level of risk. So we're going to start off at the low end, and I didn't talk about this previously, but we're going to start out with certificates of deposit, also called CDs, which are generally offered by a bank. Now, the national average for a certificate of deposit is about 1%, which, if you don't know anything about investing, 1% could sound great to you. But if we compare it to inflation, I mean, the average inflation is about 3%. Sometimes it's much higher than that. if you're investing in something that's offering a 1% return and inflation is 3%, you're actually losing money. So it's not a great investment vehicle. It's probably better than just putting it in the savings account, but it's not great. And the point of talking about these different rate of returns is, if you want to grow if you want to become financially free, you need to grow your wealth. And if you can grow your wealth faster, you'll be able to obtain financial freedom faster. And one of the ways you can grow your wealth faster is by having a higher rate of return on the investments you select. So we're trying to demonstrate the different types of investments and the rates that they generally offer so that you can plan appropriately about what would work well for you at this point in your life so that you can gain financial freedom. So next, we're going to talk about bonds. And I'm going to break this into two categories. We have government bonds and corporate bonds. Now, government bonds are from the government. And we would like to believe that the government is very stable and that they will continue making payments on things. So the government bonds are less risky, which means they offer a lower rate of return. The national average that I found for government bonds was 5.5%. So that's a decent return. If you're needing more of a passive strategy and you want real stability in your investments, government bonds could be a great option. Corporate bonds are slightly higher. They, on average, offer a 6.5% rate of return. And the reason for that is corporate bonds are slightly more risky than government bonds. Now, we're not going to get into this in this episode. There's many different layers of bonds. There's different bond qualities, and those can offer higher rates of return. These are just average numbers. And something to be looking forward to. In future episodes, we are going to go deep dive into each of these categories to give you a much more thorough understanding of them. So we're just trying to give you a big picture right now. The next thing we're going to talk about is stocks. And I broke this into mutual funds and individual stocks. So the average rate of return for a mutual fund is 6%, and individual stocks, the average rate of return is 8%. So again, similar to bonds, slightly higher with individual stocks, but not super impressive. We're also going to talk about real estate. And when I was looking this up, they broke it into real estate investment trusts and also just real estate, generally speaking. And they listed both of those at 10.5% as an average rate of return. Now, real estate, if done well and actively, can offer a much higher rate of return, along with some of these other things. But these are just average numbers to be thinking about. The last one I'm going to talk about is small businesses, which we talked about previously. I was not able to find a good average rate of return for small businesses. And I think one of the reasons for that is because it's really hard to judge a small business investment, because your rate of return could be all over the place with that. You could, like I said, you could lose money on a small business, or you could have a really amazing rate of return if the business does really well. So again, don't focus on the numbers that I was using. Focus on the fact that different investments offer a different risk level, and with that, a different rate of return. So depending on where you're at in your life and your investment time horizon, focus on investments that would help you now accomplish the goals that you're trying to achieve. Earl or Roger, do you have anything you want to add to the rate of returns discussion?
Absolutely. When you look at the certificate of deposit, last year in real estate, the price of houses went up 27% in the Wasatch Front. So the house went up 27%. If you had a certificate of deposit, you got 1%. Inflation in 2022 was 9%. So realistically, inflation will cancel out all your money. If it's in a certificate of deposit, it'll drop it down about 9%. And you couldn't even afford the cost of eggs.
Great point.
Very good. The other thing I would, Ben, we see stuff in private lending type, where things are invested in real estate, private offerings, so to speak. How do those returns compare with something similar to this?
So a private real estate offering is is a slightly higher risk level of investing because there's less liquidity and there's things that could go really well or could go really wrong, which that's why it's a higher risk level. But it's normal to see a private real estate offering to offer somewhere between a 12 and an 18% annualized return. So that is much higher than a lot of the investments we've talked about previously. But again, if there's a higher risk level involved. And if you aren't comfortable with that, you should be doing your due diligence on any investment that you put your money into.
Thanks very much. I appreciate that, you guys. So I want to take just a second. We've talked about risk versus return a little bit. When I was in college, I was introduced to a concept, how you can mathematically calculate the relative risk of investing in a different type of investment. And so one of the things, if you were running a mutual fund, what you would do is just say, oh, hey, which is the highest rate of return? Let's invest all of our money in that, right? But the problem with that is, if you take, for example, the stock market, there have been times when people have invested in the stock market and got 12 to 15%. Because the stock market hates high interest rates, right now, I think the average rate of return is probably down around 5 or 6 if it's not flat completely. And it depends on your portfolio and those types of things. We're just talking about averages. But there's a wide variation between earning 4% and 12 or 15 versus if you're talking about bonds, they're affected by interest rates also. Their total rate of return, and maybe you'd get a 6%, or the high would be 8, right? So there's a much smaller variation when you're talking about certain types of investments. The lower risk would have less variation. The higher risk would have, you can earn anywhere from 0 to 15 type of a rate of return. Some mathematician came up with what they call beta analysis, and they said, look, if we invested in every single investment out there or every single stock that's out there, and we gave that a beta of 1, then something that was less risky would have a smaller beta. It would be 0.75 or 0.6 or something like that. Something that was higher than a beta of 1. A brand new startup company, for example, that you invested in might have a beta of 1.2 or 1.5. And the whole idea is that you can now, and don't want to teach a whole class on this, but I just want people to understand that there is a way mathematically that you can adjust those rates of return. If you sit down with a financial planner and you tell him, I just invest everything in high growth stocks, hopefully he's going to come back and say, this is, you might get a high rate of return, but you also have a higher probability that you may lose everything because it's such a high rate of return. So just keep in mind that that rates of return aren't the only thing when we start to invest. We also have to look at the relative risk factor. The other thing that I learned when I was in college, and it's called the perfect market theory. And I took a class on advanced options trading. My degree was in finance, and I was all excited. I went and sat down in this class thinking, oh my gosh, they're going to teach me how to outsmart the stock market. That's really what I went there for, is if I could just figure out how to outsmart the stock market, I would, I could win at all my investing. Quite honestly, that's one of the main reasons I went back to school. I thought I wanted to work on Wall Street for a period of time. But I sat down in this class, and I was really close to finishing my degree. These were one of the senior level finance classes. The professor stood up and he said, most of you guys are here because you think I can teach you how to outsmart the stock market. And I'm like, what did he know? You know, I'm sitting there thinking, he's looking right at me, man. He says, I'm going to tell you right now that is impossible. And I'm going to tell you why. He said, but before I get to that, he said, if that's why you're here, and this is going to age me a little bit because nobody today knows what a drop card is. But back in the day, they used to have cards instead of computers that, you know, you picked up an ad card and took it to the professor and said, here, sign this and let me in your class, or a drop card that you took back to the registrar's office. Anyway, he said, there is a whole stack of drop cards back there on that chair at the back of the room. He says, I don't care if every single one of you guys gets up and grabs a drop card and goes and finds something else to another class so that you can graduate, because there is no way that I or anybody else in this department is going to teach you how to outsmart the stock market. And the theory that he used, and this is important, I think, to understand this. When so many times we think that we can just, you know, get a little information. I can pick my stocks myself and outsmart, you know, the market. He said that the perfect market theory says that when you have a market in which every bit of information is shared with everyone at the same time. The theory is that every single investor gets the same information at the same time, and it's not 100% true, but it's pretty accurate, right? He used the example of the Wall Street Journal, right? You get up and somebody has just announced IBM has a new patent that they just announced, and it's there's an article on it in the Wall Street Journal. And so at 5 o'clock in the morning, it hits the people in New York, the East Coast people first, and an hour later it's in the Midwest, and then an hour later it's in California. And as soon as you get that information, right, you should, if you pick up and call your broker and say, hey, I want to throw some money at IBM. They've got this new technology. And what he says is that you're probably too late already, because somebody's already invested in that. And so the idea of, hey, I'm just going to read the Wall Street Journal and go invest in a you know, what's hot today. What you're actually doing is somebody else bought it up to the new value of that, and you're the one that's going to push it way beyond that value. And you may make some money theoretically, but it becomes more risky to do that. And the other way he described this, he said, you know, every single company, you know, you think about the big companies, the Dow Jones companies, the S&P 500, they have 3 or 4 highly trained Harvard MBAs that are analyzing each and every stock, right? Some of those guys are playing golf on Sunday afternoon with the CEO of the company, right? And he's kind of whispering to them, hey, this could be going up, and, you know, or we've got this new technology. And those guys have already traded on it long time before it hits the Wall Street Journal, and I get a chance to do that. Now you got to be careful. We all remember Martha Stewart, who spent some time in jail. So the SEC tries to stop this type of information so that it's supposedly fair for everybody. But the truth is, nothing in life is fair, right? We weren't all born to exactly the same station in life. Some of us have a little head start when we get started. Some of us start behind. And it's the same way with investing. And the idea is, when you go to invest, if you said, hey, I'm going to invest my portfolio in stocks, and I'm going to go learn as much as I can, I'm going to research 4 or 5 stocks and go invest in them, the chances are that you're going to get an average rate of return, right? If that's 10, if it's 12, if you invest in high growth stocks and the average rate is 15, if you hold on to it long enough, you're probably going to get that average rate of return. But it's unlikely that you're going to get 25 or 30%, which is well above the average rate of return for that. because there's so many other people. You're competing with so many other people that are analyzing those properties or those stocks. I always joke that the reason I got into real estate is because every property in real estate has a different value, right? It's not every single share of IBM is printed exactly the same way. The certificate looks the same. It's a small piece of a company that's doing something. Every piece of real estate is different and is valued differently. Wall Street for years has wanted to try to control the real estate market. And what they find is that they can trade, they have about 75% of the information that they need to trade on real estate, but they don't have every bit of it. That some of it has to rely on people with local market knowledge expert. And all that means to me as an investor is that I am probably going to be more likely to outsmart the real estate market than I am going to be able to outsmart the stock or bond market. So,
well, I've got some thoughts I'd like to add on top of that.
Absolutely.
So we're talking about financial freedom and trying to obtain that for ourselves and for our listeners. And in order to do that, we have to be investing, and we have to be investing as wise or as smart as we can. And we've talked about different rates of return on these investments. If this was a perfect world and we could put, let's say, $100,000 into an investment and it would get a 10% rate of return every year, we could be pretty confident in what our retirement number is going to be. But the reality is, in the real world, it doesn't always play out like that. So we can choose to accept either a lower rate of return, or if we want to get a higher rate of return, we have to, in some way, be an expert or partner with an expert. Because all the investments we talked about, it's very possible to get an above average rate of return if you are actively involved in that specific investment and you are truly an expert in that category. So like with real estate, you could easily get an above average rate of return if that's all you were doing. If you were really good at it, you can get a better return than most people. But if you're like most of the world, you have a day job, you have a career that takes most of your time. And there's all these different investing strategies. So if you're going to be good at it and you're going to get a better rate of return, you have to be willing to put the time in. Now, you can do that with all these. There's plenty of information available for all these investment strategies that you could use to get that above average rate of return. But if you're not willing to put the time in to truly be an expert in that, then you need lower expectations about being able to beat the average. Now, the alternative is if you want to invest in a specific category and you are hoping for an above average rate of return, your best option is to find some type of a partner that you believe is a true expert in that field. So whether it's real estate, stocks, it doesn't matter. Either you need to be an expert, you need to find an expert, or you need to be okay with a pretty average rate of return. So we're talking about trying to cut your investing time horizon in half or greater. The best way to do that is by getting an above average rate of return. So again, if you are willing to put the time in, you can do it on your own as an active investor. If you don't have the time or you don't want to spend the time, you need to find somebody that you can partner with that's able to help you get an above average rate of return so that your investments can grow faster than if you just put them into a mutual fund or something like that.
Hey, thanks. I agree 100% with that. Roger, you do quite a bit of flipping. I think we've all done a little bit of it, but you seem to have, of all of us in the group, you seem to do a lot more flipping homes. Why don't you talk a little bit about how active or passive that is, and maybe talk about some of the high rates of return that you've got from doing that?
Sure. Right now I'm flipping 7 different things, and that's me personally. As far as being active, there's no way to describe how active I am. Yesterday, I spent about 12 hours doing LVP and tile and grout and hanging doors and casing and everything else. That's as active as you can possibly be. I have money partners that are in those properties, and they're very passive. Yesterday, my partner, Chris Warnick, actually was he was building IKEA furniture. So his passive stage ended when he picked up the impact driver. We also do hard money loans where the level of activity is much, much lower. The loan will come from underwriting the property, looking at what the after repair value is, and definitely very passive, just a few conversations here and there where they check in, find out progress, find out what you're selling at, and get updates as things go on. And then you look at passive investors. You could be the owner of the money, where the hard money lender loans out the money, and then you only get like an update at the beginning, maybe once or twice during the middle, and then at the very end. So very passive.
Perfect. And when we're talking about active versus passive, we've talked a little bit about investing, even when we're investing in income properties itself, right? There are a couple of different strategies. As an example, we as a group, when you think of buying an apartment complex, most people would say that's a passive investment, right? You're buying something to get to get capital paid to you the mailbox money, most people call it, right? And that becomes a passive investment. Today, with today's interest rates, and cap rates that are being driven down because interest rates are low, that means cap rates are down. That means your cash on cash return goes down. Right now, cap rates are somewhere, and they're going back up again, but over the last year or so, we've seen cap rates as low as 3.5%, 4% here in the Utah market, and probably 5.5 to 6% in some of the other markets that we invest in. And so, investing in income properties for pure cash flow today gives you a somewhat limited rate of return today, just based on where the market is. One of the things we do to supplement that is that, real estate, you invest for cash flow, but a lot of times you hold it long enough and it continues to go up in value. Well, one of the things that we love to do is force that value up. And so we'll buy something, a real estate project that I know that I can raise the rents by $200-$300 a month. And so you do that by putting quite a bit of value in. A value add project is basically what we would refer to it as. And what you get is somewhat of a blended rate of return, right? We get a 2 to 5% cash on cash rate of return because we bought the property and we're holding it. But in addition, sometimes we're getting 30-40% rate of return. As the value of the property goes up, we're increasing the value substantially, and typically trying to sell those fairly quickly afterwards. And so it's kind of a blended strategy where we're combining cash flow with growth. Similar to combining a portfolio of aggressive growth stock versus and throwing in some income stocks to go with it. What that does for us, I think, is reduce the risk quite a bit, because if I can't get the value enough to sell this when I hope to do it, it's going to allow me to hold on to these things. They'll continue to make the payments. They'll eventually go up in value. But if I'm successful at raising my rents and increasing the value, then those become significant growth opportunities, and they magnify the rate of return on those investments by quite a bit. Ben, you started with a small portfolio that you put together. I know that you intended to make them passive, but I think they ended up a little bit more active than what you thought you were going to get into. Tell us a little bit about your portfolio that you put together a couple of years ago.
Well, before I tell you about my portfolio, I want to tell you why I had a portfolio. So at a pretty young age, I had an opportunity to be exposed to a lot of really wealthy people. And I would always try to understand what they did to acquire their wealth. And one of the common themes I saw in these people was that they did some type of real estate investing. So I was like, paying attention, light bulb, these people are investing in real estate. So I need to invest in real estate so that I can become wealthy. I knew it was a great way to grow wealth, and I saw it in them. But I didn't see the struggles that they went to get to where they were. I just knew that they had used real estate to get wealthy. So I started reading some books, but the reality is I really didn't know much about real estate investing. I just jumped in head first because I wanted to become wealthy through real estate. Now, I started out pretty small. I had a single family home as a rental. Then I started buying fourplexes, and then I bought some bigger properties. And I got to a point where I had 29 units, or 29 doors, as we call it, which is a small portfolio. And I was doing this as a side hobby or a side hustle, if you want to call it that. I had a full-time job. And my personality has been that I like to do things on my own to save money. Now, I'm going to repeat that. I was trying to save money, but I'm here to tell you I wasn't saving as much money as I thought I was. All right. So I had a full-time job. I had these 29 units, and I want to talk about the night that broke me because I realized I was doing it wrong. I had these 29 units that I was self-managing, which means I was the one that bought the buildings. I was the property manager. I was the leasing agent. I was the maintenance repair guy. I was everything, which was extremely educational, but took a lot of time. So earlier, Earl was saying that a lot of people think apartment buildings are passive real estate investments. I'm here to tell you there is no part about apartments or rental real estate that is passive. Somebody has to be actively managing real estate in order for it to produce the returns you're expecting. So the night that broke me, I had these 29 units. I had a full-time job, and I had at least one, if not two, empty units. And when I had an empty unit, I did my best to get it re-rented as quickly as possible, which means I would go in and try to improve it. So I was the repair guy. I was doing some paint and putting in new flooring, a bunch of things to improve this unit so that I could rent it at a higher rate. But it was like 11:30 at night, and there's other people living in this building. So I'm probably waking everybody up, but I'm like covered in dust and paint and everything. And this is, again, it's 11:30 at night, and I'm just exhausted. And I said to myself, I'm doing this wrong because there's got to be a better way to do it. And the reason I'm saying I was doing it wrong was because I thought that doing it myself would save money. But the reality is it was taking a ton of my time. It was taking away from my ability to focus on my actual job. And I wasn't getting better rental rates than property managers were. So I wasn't willing to pay a small fee to have somebody else help me when I could have probably netted more money. I was trying to do it all on my own. And the point there is that there's different ways you can invest in real estate, but all real estate is some type of an active investment. So you can choose to be an active investor. There's nothing wrong with that. Just have the correct mentality that if you're going to get the return you're hoping from that real estate investment, you're going to be putting in a lot of your time and energy to make that happen. Now, if you only want to do like one single family home as a rental, you could probably do that as a side hobby. It would take a couple hours a month, maybe not that big of a deal. But if you want to retire with real estate income, you're going to need a much larger portfolio, and it's going to take a ton of your time. Now, you might say, like we talked about a little bit earlier, maybe I'll just hire a property management company to run my project for me, and then it'll be a passive investment. I'm also here to tell you that's not as realistic as you might hope it would be, because as a real estate owner, the returns that the property produces is really the owner's responsibility. And I'll give you an example. We have a project that we are currently operating, and we have a property management company helping us with it. And recently we had a water heater go out, which not a big deal. That's normal in real estate. And we needed a new water heater. So the property management company sent us a suggestion for a company to replace it. And I'm not going to use specific numbers, but they gave us a number that we thought was a little unrealistic. And we knew that because we manage plenty of other units. So we said, this looks a little high. So Earl went and did some digging to find a different company. And at the end of the day, we were able to save quite a bit of money by just finding a different company. So we are able to increase the amount of net operating income we're producing for that project just because we're still actively involved. Now, there's many other stories we could tell with the same ending, but the point is real estate investing is not a passive investment unless you're partnered with somebody who's doing the active day-to-day operations. So I talked about this a little bit earlier as well. We as a team focus on real estate investing. We consider ourselves experts in that field. If you don't know this, I have also gotten my master's in real estate development from the University of Utah because I wanted to be a true expert in the real estate field. But we're not here just talking about real estate. We're talking about investing. And again, there's plenty of people in this world that are experts in their field. And I challenge you that if you're going to invest in any specific category, to find a true expert in that field or become one yourself so that you can get the above average rate of return and help grow your wealth at a faster pace.
Ben, what was your full-time job during that time?
Great question, Roger. I was working as a residential real estate agent. So I was still very much in the real estate world, but I was trying to help clients. And if you don't know this, real estate agent schedules are really all over the place. So I was working a ton of hours anyways. And to do that as a side hobby, side investment, was basically a second job.
Cool. You said the night that broke you, was it a big drama thing, or what happened that made you say that?
Well, I had like a nervous breakdown because I was so exhausted. I can't really explain what happened, but I was like sitting on the floor in this unit by myself. It's pretty much pitch black because I'd shut the lights off, just trying to calm myself down. I had just taken on more than I could chew at the time. And I realized that I would be much better off building a team to do it correctly.
Got it. One thing that is a known fact is 76% of all self-made millionaires did that with a real estate vehicle.
Very cool. So I just want to just leave you all with one of the thoughts that I have is as we go through and discuss some of this is truly every aspect of investing to an extent has to be somewhat active, right? Even if you just pick the difference between one mutual fund or the other and which one, and they need some degree of financial education to make those decisions. A lot of people just pick the best financial planner that they can and have them pay take care of all those for them. You're going to probably get a little bit lower rate of return, but if that's where you get started, it doesn't matter where you are. We all need to figure out exactly where we're at today. We need to figure out what it is that we can do, where we can start from where we are today, and just take that next step. Continue to grow your wealth. I can tell you from personal experience that it can happen once you start to take those basic beginning steps, that this will happen much, much faster. And if you're at the point where it's starting to happen faster for you, there are some very specific, get yourself some help if you need it, but find someone that can help you direct the money that you have into something that will get you much, much higher rates of return, and hopefully at a lower risk level also. So we encourage you guys to once again share this with other people that you might think would benefit from this, and encourage you to come back next week when we're going to have another great episode. All right. Once again, thanks to everyone for joining us. We wish you guys all well in your financial preparedness. And again, thanks for listening to our episodes.
Hope you got value from this episode. And if you have a minute, then take the time to leave an honest written review for the podcast, because we take those reviews seriously and it'll help us serve you better on the next episodes. And most importantly, be sure to start taking action so you can control your financial future today.